So we need to gain another level of support for both gold and silver. But, it wasn't just 3 months ago that we were kind of wondering, is, 2000 going to be support or resistance, as you said? And of course, obviously, it's now support. We got a nice big move up past 2,400 US dollar terms. And in that missive, I said it's only a nominal all-time high. If you use the US government CPI calculator, so we're using their numbers, you need $3,222 gold to equal the purchasing power of a 1980 $850.
In today's market recap, why is the gold rally leaving silver behind? Gold is responding atypically to interest rate expectations, with prices rallying even as the number of expected rate cuts decreased. Slower growth in China and tighter central bank policy may be preventing silver from rallying higher. Normally, gold prices do the opposite of what interest rate expectations do. When bond traders expect more rate cuts, gold typically rallies. When they expect fewer rate cuts or more rate hikes, gold usually falls. In the past couple of months, however, gold has rallied despite Fed funds futures depricing many of the cuts that traders had previously expected for 2024. It appears that one or more large investors has taken a long position in out of the money call options on gold, sometimes with strike prices as high as $3,000 per ounce, perhaps positioning themselves either for large rate cuts that are not currently anticipated by bond traders or for increased geopolitical instability. Silver playing catch up. The fact that the rally has not fully translated to silver may be an indication that either the gold rally is overextended or that silver has substantial catching up to do on the upside. Now we'll show you the best excerpts of the latest interview, but first, hit the like button, smash the subscribe button, and share this video with a gold bug. Enjoy the episode.
I think that's important, really not for maybe our viewers, but someone that's coming on board now, like, gold is too high, it's its all-time high. It's all-time nominal only. So coming back to the other question, I think I looked at the chart. I've done a lot of technical work. I don't feature it a lot in the Morgan report, but we look at it from time to time. It looks like it could do a head and shoulders top. I really doubt that with the all this going on geopolitically, the war drums, the conflicts increasing with Iran involved now. I can see a correction, a high-level consolidation further. Silver's launched later than gold. We all knew this time gold had to lead the way it has. I really want to see silver over 30. And from my perspective, Elijah, to finish, I do not see this as the high point for the year. I think we're going to get over 30 for silver and probably hit the 25 mark at least in the gold market. I've been looking at it not as long as Ted Butler, but almost, because I was probably one of the first to find Ted way back in the 2000, 25, 24 years ago. Anyway, right now, from the latest report out on the 23rd, futures only, you've got the trading funds at 86,000 contracts long and 26,000 short. So you do that quick arithmetic, you're looking at 60,000 long. That's kind of the upper end of the extreme. Usually it's 50,000-ish. It's 10,000 above that. You look at the commercials, the ones that control the market, the major banks, bullion banks, and their cohorts. They're 120,000 contracts short and only 43,000 long. So there again, you've got a pretty big overhang of paper silver overhanging the market without much more ammunition. What's ammunition? It's what an investor uses or talks about in slang terms as dry powder, new money. And in order for this market to move much further, you need new buying pressure. And it's already come off. We haven't seen any increase in buying pressure. In fact, selling pressure, that's why the price is down. So I think we're going to see more downside than upside based on the latest commitment of traders. Yeah, of course, short and long relative. So I see the market from the construct right now, both in the physical realm and in the futures markets, going into the summer's doldrums, meaning that the metals pull back in the summer, as they almost always do. And then there's a gap in the chart for silver at 26 something, 30, I believe, somewhere in that. I expect that gap to be filled. I don't expect it to go a lot below that, maybe 25 or so. And I think that'll take most of the summer. The old adage, sell in May and come back after Labor Day. So I think that'll hold for the metals as well as the general stock market. And we'll be able to come back in probably late summer, early fall, and we'll start to build from wherever we end up, back up. And of course, the black swan factor is always out there. We always have to think about it. That could change everything almost instantly. But barring that, I think we'll get a down market through the summer months and up market starting in the fall. I think it'll get a pretty good run at the end of the year. It'll be really interesting to see what happens going toward the November election. How much turmoil, consternation, what's going on with not only market activity, but the rhetoric from the mainstream press, the mainstream financial press, the world commentary on the U.S. election. A lot going on this year. I think the best thing to do is be balanced. You need some precious metals. You don't have to overload, but you don't want to be underweighted either.
On today's news recap, silver prices stabilized after economic data showed signs of persistent inflation. Silver prices edged up by 0.23% amid a backdrop of rising U.S. Treasury yields fueled by lingering concerns over persistent inflation. The latest economic data indicated a slowdown in U.S. economic growth for the first quarter, but an uptick in inflationary pressures suggested that the Federal Reserve might delay interest rate cuts until September. Despite the tempered economic growth, positive indicators in the labor market were observed, signaling continued strength in the employment sector. Looking ahead, the Silver Institute Industry Association forecasts a 17% increase in the global silver deficit to 215.3 million troy ounces in 2024. Silver's diverse applications in jewelry, electronics, electric vehicles, solar panels, and investment purposes underpin its sustained demand amidst a structural market deficit entering its fourth consecutive year. First, like, subscribe, and turn on notifications so you do not miss out our daily videos. Enjoy the episode.
Right. Yeah, it's most markets too. I remember in my much younger days, there was a front page business of the LA Times, and it showed the stock market doing this, parabolic move. And basically the commentary on that particular day was that, how much higher can it go? And the answer is it was about double from there. So once these really extreme moves go, they can really go no matter the market. I think the reason I'm still so bullish is because there aren't too many investments outside of the cryptos that are true alternatives to the conventional real estate, bonds, and stocks, unless you own a business or something, own the business rather than own stock in a business. So I think there'll be more frightened capital that'll move out of conventional investments and into the metals than ever before. Certainly the money supply is bigger than it's ever been on a global basis. And it's a world market, not just a bunch of Americans that are concerned about us, bifurcating from a sound money system into a fiat-only system. And in those days, since I was aware of it, I participated or whatever, that's such a small percentage of the population. Today, almost everybody knows it. They may not have taken action yet, but they have the ability to take action more quickly than ever before. It's a mouse click and you can buy a gold stock. It's a mouse click and you can buy from Miles Franklin, for example. I think their website's up. I'm not sure, but it's at least a phone call. There's not much to it. China has real estate. Well, with Evergrande and all these other big firms in China with these ghost cities and these apartments that are half built and all the, let's say, real estate failures, they have did a switcheroo from real estate being the most stable, best investment you can make and move back into gold. And that's a 1.4 billion population. So I think that's what's really going on. I think it's not so subtle, but I don't think too many. I'm probably the first one on your show to say it. Call them as I see them, as you well know. You've known me for years. And that's how I see it. So it could be a lot bigger than, oh, the Chinese like gold. If their whole consciousness in investing shifted from gold's better than real estate, we're just getting started. I actually put up a post, you might have seen it on Twitter, but the Chinese go crazy in quotation marks for gold. From my experience, I lived in San Francisco. I've been to Chinatown many times. I love the Chinese. It gets me so politically correct, but my take is they take a pretty strong view on being risk adverse. There's a lot of gambling in the Chinese community. If you're going to speculate in, penny mining shares, that's sort of a gambler's mentality. My point being is I think it's just getting started. I think it's a true change. If I'm right, that big parabolic move I keep alluding to could be fueled primarily by the East, not the West.
What do you think of his take? Do you think $3,000 gold calls of institutional traders will pan out? Post in the comment section your views and watch this video right here because you'll love it.